When you buy a stock, you're buying a tiny piece of a company. This means you become a part owner of that company, no matter how small your share might be. Stocks represent ownership in a company and entitle you to a portion of its profits and assets. It's like owning a small share of your favorite restaurant or store. Imagine walking into your favorite coffee shop and knowing that you own a part of it. This ownership can be both exciting and rewarding, as you get to be a part of the company's journey and growth. As a shareholder, you have the potential to make money in two ways. The first way is through dividends, which are payments made by the company to its shareholders from its profits. The second way is through capital gains, which occur when the value of the stock increases over time. Dividends provide a steady income stream for investors, especially those who hold a significant number of shares. This is called a dividend. Dividends can be a great way to earn passive income, as you receive payments simply for holding onto your shares. Imagine getting a little bit of money just for owning a piece of the company. This can be especially rewarding if the company is doing well and consistently paying out dividends. Over time, these payments can add up and provide a nice supplement to your income. The second way to make money is if the value of the stock goes up. This is known as capital appreciation. When the company's performance improves, or if the market perceives the company to have strong future prospects, the stock price can increase. Let's say you bought one share of a company for $10. Over time, as the company grows and becomes more profitable, the value of that share can increase. This increase in value is what investors aim for when they buy stocks. If that company does well and its stock price increases to $20, your share is now worth double what you paid for it. This means you have made a capital gain of $10. Capital gains can be a significant source of profit for investors, especially if they hold onto their stocks for a long period. You can then choose to sell your share and make a profit. However, it's important to remember that stock prices can go down too. The stock market can be volatile, and prices can fluctuate based on various factors, including economic conditions, company performance, and investor sentiment. Bonds are different from stocks. When you buy a bond, you're essentially lending money to a company or the government. Think of it like giving a loan to a friend, but instead of your friend, it's a large organization. These organizations need money for various reasons, like building new factories or improving infrastructure. In return for lending them money, they promise to pay you back with interest. This interest is like a reward for letting them use your money. Bonds typically have a fixed interest rate and a maturity date. The maturity date is like the deadline for your friend to repay the loan. On that date, you get your initial investment back, plus all the interest that has accumulated over time. Investing in stocks is often compared to riding a roller coaster. The journey is filled with exhilarating highs and nerve-wracking lows, making it an adventure that requires both courage and patience. Just like a roller coaster, the stock market can be unpredictable, with sudden twists and turns that can catch even the most experienced investors off guard. There can be thrilling highs when the market is performing well, and your stocks are increasing in value. These moments can bring a sense of euphoria, as you watch your investments grow and your financial goals come closer to reality. But there can also be stomach-churning lows when the market takes a dip, and your investments lose value. These downturns can be stressful and disheartening, causing investors to question their decisions and strategies. It's important to remember that market declines are a natural part of the investment cycle. The stock market is influenced by many factors, including economic conditions, company performance, and even global events. News about interest rates, inflation, and employment can all impact market performance. These factors can cause stock prices to fluctuate constantly, making stocks a potentially riskier investment than bonds. The constant ebb and flow of the market requires investors to stay informed and adaptable. However, with higher risk comes the potential for higher rewards. Investors who are willing to take on more risk may be rewarded with significant returns, especially if they invest in high-growth sectors or emerging markets. Over the long term, stocks have historically outperformed bonds in terms of returns. This long-term growth potential makes stocks an attractive option for investors who are looking to build wealth over time. Section 4. Bonds, the safe but slow ride to growth. Unlike the stock market roller coaster, bonds offer a much smoother ride. Since bonds represent a loan with a fixed interest rate, you know exactly how much you'll earn over time, regardless of market fluctuations. This makes bonds a more predictable and stable investment option, especially for those who prefer a less volatile approach. However, This stability comes at a cost. Bonds generally offer lower returns compared to stocks. This means that while your investment might be safer, it could take a lot longer to grow your wealth significantly. Bonds are often favored by investors who prioritize capital preservation and income generation. They're particularly popular among retirees who rely on their investments for a steady stream of income. Section 5, Apple versus Treasury bills, real-world examples. Let's look at some real-world examples to illustrate the difference between stocks and bonds. Understanding these differences can help you make more informed investment decisions. Stocks and bonds serve different purposes in a portfolio, and their performance can vary significantly over time. Imagine you could invest in either Apple, the tech giant, or a U.S. Treasury bill. These two investment options represent the spectrum of risk and return in the financial world. If you had invested in Apple a decade ago, you would have witnessed substantial growth. Apple's stock has been a remarkable performer, reflecting the company's innovation and market leadership. Apple's stock price has increased dramatically over the years, driven by innovation and strong product demand. The company has consistently launched new products that have captivated consumers worldwide. Your initial investment would have multiplied significantly, and you might even be receiving dividends as a shareholder. Dividends are a portion of the company's earnings distributed to shareholders, providing an additional income stream. On the other hand, investing in a U.S. Treasury bill would have been a much different experience. Treasury bills are short-term government securities with maturities ranging from a few days to 1 year. Treasury bills are considered one of the safest investments as they're backed by the U.S. government. This backing provides a high level of security, making them a popular choice for conservative investors. You would have received regular interest payments and gotten your principal back at maturity. The interest payments, though modest, are guaranteed, providing a predictable return on investment. However, the returns would have been much lower compared to Apple's stock performance. While Treasury bills offer safety and stability, they do not provide the same growth potential as stocks like Apple. This example highlights the trade-off between risk and return that investors must consider. In conclusion, both stocks and bonds have their place in a well-diversified investment portfolio. Stocks like Apple can offer high returns but come with higher risk, while Treasury bills provide safety and steady, albeit lower returns. Understanding these differences is crucial for building a balanced investment strategy that aligns with your financial goals and risk tolerance. Section 6. So, which one is right for you? The choice between stocks and bonds depends on your individual financial goals, risk tolerance, and time horizon. If you're young and have a long-term investment horizon, you might be more comfortable with the volatility of stocks, as you have more time to recover from potential market downturns. On the other hand, if you're closer to retirement or have a lower risk appetite, bonds might be a better fit for your portfolio. They can provide a steady stream of income and preserve your capital, which is crucial during retirement. Section 7. Keep learning, keep growing. This essay has provided a basic overview of stocks and bonds. However, investing is a vast and complex subject. It's essential to conduct thorough research, understand the risks involved, and consider seeking advice from a qualified financial advisor before making any investment decisions. Remember, investing is a journey, not a sprint. By continuously learning and making informed decisions, you can work towards achieving your financial goals and securing your financial future. Subscribe to our channel for more insights and tips on financial vehicles. Keep learning, keep growing.